Today, we're diving into a critical discussion about the looming currency crisis and the future of the dollar, especially under the potential leadership of Kamala Harris.
Joining us is renowned economist Peter Schiff, who warns that current economic policies could push the dollar toward decline while sending gold prices to unparalleled heights.
Stay tuned as we unravel insights that can save you time and protect your investments.
Welcome to Financial Insights in Minutes, where we summarize the most pressing financial news of the day.
In this episode, we explore Peter Schiff's predictions regarding potential economic turmoil and its implications for inflation. Let's dive in. Today, we're discussing a potential currency crisis that could reshape the global economy. Renowned economist Peter Schiff joins us to explore how shifts in leadership could impact the dollar's future.
Absolutely. Schiff has long warned about the impending instability of the dollar and the inflation crisis. Buckle up, viewers. It's about to get insightful.
So what's the main thesis Schiff is pushing?
Schiff argues that economic policies under Kamala Harris could accelerate the dollar's decline, pushing gold prices towards potentially $10,000.
What are some key insights about the dollar's risk?
Schiff highlights that sentiment around the dollar is precarious, particularly if Kamala Harris becomes president, indicating a shift away from capitalism that could irreparably damage the dollar.
And what's the outlook for gold?
Schiff suggests that as global confidence in the dollar diminishes, gold could soar to $10,000, reinforcing the undervaluation of gold by many investors.
Inflation seems to be a significant concern. What's the scoop?
Schiff warns that if the Fed cuts rates again, inflation could spiral out of control, leading to soaring costs for consumers and increased economic instability.
What does Schiff predict for the dollar?
He foresees an imminent collapse if current policies persist, with hyperinflation making gold the go-to asset for stability.
And what's the long-term outlook for a return to the gold standard?
Schiff believes a return to a gold standard may be inevitable as central banks aim to restore trust and stability amidst fiat currency failures.
So what's the key takeaway from Schiff's insights?
He emphasizes the urgent need for a paradigm shift in financial management, or we may face a tumultuous economic future.
As we wrap this up, what should we keep in mind moving forward?
It's vital for viewers to think critically about their investment strategies. Are you prepared for what's coming? Let's hear your thoughts in the comments.
Let's dive right in. Today, we're breaking down the latest jobs report and its immediate impact on the markets.
Absolutely. This is the backdrop for heightened volatility, and we'll reveal how the new data skews market outlook.
So what's the core focus of today's discussion?
The thesis centers around the jobs report indicating a slight decrease in unemployment rates, alongside unimpressive job growth, prompting cautious market behavior.
What was the standout highlight from this report?
The unemployment rate ticked down to 4.2%, which is encouraging. However, job gains fell short of expectations, raising concerns.
And what about the job gains?
Only 142,000 jobs were added, significantly below projections, presenting a stark contrast to the positive unemployment drop.
How did the markets react post-report?
Stocks jumped initially, but uncertainty remains as traders ponder potential implications for future interest rates from the Fed.
What predictions can we draw from this data?
Markets are weighing chances of delayed rate hikes. If inflation rises, the Fed will face mounting pressure.
To wrap up, what are the key takeaways?
The jobs report sends mixed signals. A decrease in unemployment is promising, yet weak job growth reveals underlying challenges.
We'd love to hear from you. How do you plan to navigate these currents?
Drop your thoughts in the comments. It's crucial for all investors to stay informed and proactive.
Time to navigate today's discussion on government price controls and what history reveals about this senseless remedy.
Absolutely. Price controls are back on the table, and history suggests such measures may lead to disastrous outcomes. Let's dive into this further.
What's the essence of this price controls argument?
The government's past attempts at price controls during economic downturns have historically failed and often worsened the problems, a dreadful cycle of ineffective political responses.
Let's break down significant lessons from history. What happened in 1971?
In June of 1971, wage and price controls were introduced, significantly constraining growth and causing unforeseen repercussions throughout the economy.
What are the real-world repercussions of such controls?
They generated product shortages and ignited long-term inflation. Even after price controls were lifted, the damage lingered.
And how did consumers fare during this period?
Consumers faced a major decline in purchasing power, struggling to keep up with rising costs, leading to severe economic repercussions.
Looking ahead, what's the presumption here?
Governments may buckle under pressure and revert to ineffective price controls again, repeating historical mistakes.
What about the future economic landscape?
Expect continued instability unless new, effective policies emerge. The repetition of history could land us in an economic quagmire.
So, what's the vital takeaway from all this?
Rigid controls seldom address deep-seated issues. The focus must shift to creative solutions and strategic planning.
Before we sign off, here's a question for you. What innovative policies do you think could prevent us from repeating these historical mistakes?
We're eager to hear your thoughts. Leave your ideas in the comments below.
Today's financial insights explore pressing decision points for stocks, driven by crucial economic indicators.
Let's go right to the facts. The market's analyzing warning signals from bond traders, especially yield curve inversions. There's a mixed bag of opportunities.
What's the core thesis we should latch onto?
The key suggestion is that while bond traders are signaling recessions through inversions, certain sectors like AI are experiencing wild fluctuations. The downturns may not be immediate, but they suggest uncertainty ahead.
Let's dissect the yield curve situation. What's happening?
Currently, we've logged 783 days since the last inversion. Typically, a recession could emerge 6 to 12 months thereafter. Patience is essential.
What about the Fed's strategies moving forward?
Goldman Sachs projects a 20% chance of recession, with potential Fed rate cuts to stimulate the markets, reminiscent of the inflation saga of the 1970s.
Which sectors show promising resilience?
Utilities and commodities are surprisingly steady, while tech, especially AI, is witnessing significant volatility. Keep an eye on the declining housing market.
What predictions can we make for the near future?
Should recession fears dissipate, bullish trends could appear given the Fed's support from potential rate cuts.
What should investors watch for concerning the tech sector?
Tech stocks may rebound from corrections if new AI trends gain momentum, so stay alert to shifts in investor sentiment.
To conclude, what's the main lesson?
Remain vigilant. The growth potential is promising despite market volatility. The key will be how traders navigate these uncertain waters.
Before we close out, what strategies are you considering with these insights?
Let's hear your thoughts in the comments. What's your game plan as we navigate these unpredictable financial tides?
Let's discuss high rates and inflation. Cole Smead, an investment management expert, joins us today to uncover the market dynamics.
Indeed, we'll delve into how persistent high rates affect investors and what this means moving forward.
What's the main takeaway from Cole's insights?
The central thesis is clear. High rates are here to stay, significantly altering the investment landscape. With an alarming deficit and low unemployment, the economic implications are substantial.
What's on Cole's radar regarding the current economic climate?
Cole warns of staggering 7% deficits coupled with low unemployment, painting a picture of ongoing financial instability.
How does the tech sector fare?
Cole discusses NVIDIA, emphasizing the need to monitor AI developments, but cautions about the volatility surrounding major stocks.
What advice does Cole offer investors?
He stresses caution regarding high-quality firms traded at unsustainable multiples, hinting at a potential market correction.
What's Cole's inflation prediction?
He anticipates inflation staying stubbornly above 3%, compelling investors to rethink strategies.
And how about regulations affecting tech businesses?
Cole implies an incoming wave of government antitrust actions targeting large tech firms, likely reshaping market dynamics and affecting investor strategies.
To summarize, what main point should investors consider?
Investors must develop strategies to navigate high rates and inflation, as traditional strategies may fall short in this evolving landscape.
That was an enlightening discussion about the potential currency crisis and its implications on the dollar and gold prices.
Yeah, Peter Schiff brought serious insights on how policies could lead to a catastrophic decline of the dollar.
And on the other side, Cole Smead urges investors to be resilient and adapt to high rates.
Despite their different approaches, it's clear there's a consensus on the looming crisis.
Absolutely. Viewers, it's vital to stay informed and prepare for these economic shifts.
If you found the insights valuable, like and subscribe to our channel so you don't miss out on future discussions.
Thanks for tuning in. Be sure to check out our other content for more financial wisdom.